Welcome to the Move IQ podcast and our first home focus series, brought to you in association with Skipton Building Society. We're sharing advice and guidance to help all aspiring first-time buyers achieve their home ownership dreams. Now, applying for a mortgage can indeed be a complex process, but with the right preparation, you can navigate it smoothly. Today, I'm joined by Umera from Skipton Building Society to answer some of the most frequently asked questions by first-time buyers. Umera, good to see you. Let's kick things off with the basics. Can you explain what a mortgage is and how it all works?
Definitely. Thanks, Phil. Essentially, a mortgage is an agreement between an individual and the mortgage lender, right? It's really important to understand that a mortgage is a long-term commitment. And it's a bit like a loan, really. That's the easiest way to kind of understand it. However, the difference is that the money is secured against a property, so a house that you would be looking to buy. You can take a mortgage over a longer period of time. So, for example, 30 years, 35, even up to 40 years these days, actually. Right. And you would then pay the mortgage back on a monthly basis if it's on repayment. And at the end of the term, you'd clear the mortgage.
And what sort of things should first-time buyers look for when choosing a mortgage?
Speak to the right person. In a nutshell, it is so important, like you would with anything else in life, is you need to speak to the right person, somebody who's qualified to give mortgage advice. It is a regulated industry, which means that a mortgage advisor or a mortgage broker would have a wealth of experience that your average first-time buyer doesn't have, right? So speak to the right person, do some research and plan ahead, in a nutshell.
How do they find the right person? I guess it's talk to their friends and what are other first-time buyers doing?
I think some other tips to take into consideration, a good place to start is, who do you bank with at the minute? You know, does your bank know you? Your bank does know you because you have a relationship with them. That's somewhere you can start. Yeah. Speak to family and friends, like you rightly said, who has taken out a mortgage recently in your circle. What was their experience like? Yeah. And then most places you'll find what we call a local broker. Right? Lenders work with intermediaries commonly known as mortgage and protection brokers. And the good thing about a broker is they have access to a panel of lenders, so not just one, but actually they will have a list of lenders that they will work with, they're familiar with, and they will also have access to their individual criteria. Yeah. So they can work with a first-time buyer, understand the first-time buyer's individual experiences, where are they at the moment in the process, what are the priorities, and really guide them through that.
I always think it's useful to have somebody on your side who works in the market on a daily basis, understands what's happening all of the time, because the mortgage markets move all of the time, and an individual first-time buyer's situation is very specific to them, and the broker can help with that.
Yeah, definitely. And I agree. Having somebody on your side who has the experience and expertise that you wouldn't have, because an average first-time buyer, they don't know what they don't know, right?
Yes, good point.
But somebody like a broker or a mortgage expert, a mortgage advisor, they have the experience and the intel that your average first-time buyer doesn't have. They will work with you, and that's what's the most important thing. A broker will work with you to try and find the right mortgage type that fits for you and your circumstances. Because it's your first time round, right? It's a really big commitment. Sure. So it's great to have somebody on board that's on your side, who understands you, but also has the experience and is qualified to make the right recommendation.
Can you talk a little bit about the kind of things that lenders are going to look for when they're considering, will they lend to you? What will they lend to you? What will the rate be looking like?
Good question. And this is one that a lot of first-time buyers have a misconception around. I think there is historically this idea that it's a bit of a computer says no or a computer says yes, and then let's move on. But it's really good to talk about what sits behind that. In the main, lenders don't look at what is happening to you just today, right? Because things can change in the future. So what lenders want to look at is what is affordable for you today and in the future, because it's a long-term commitment, like we talked about earlier. So things like your income. What does your income look like in today's world? What will it look like in the future? Are you due a promotion? Are you going to reduce your hours, go from part-time to full-time, or the other way around? Yeah. Have you got nursery, childcare costs? So what have you got coming in? What have you got going out? And what will that look like going forward? In addition to that, have you got dependents? Have you got children or elderly relatives who are maybe dependent on you? And then they will essentially make a decision on what's affordable based on their appetite for risk as a whole.
So they're assessing you and then looking at, is that a risky lend? Or if it's a risky lend, what rate will we lend at?
Yeah, absolutely. Or what's the alternative lend? Here's the other thing. I think some first-time buyers set out with an idea of an amount that they want to borrow without really opening up the minds of actually, could I borrow more, could I borrow less? And what does that mean for me in terms of the house that I'm looking at?
Yes.
What are the deal breakers? Does it mean that I can maybe sacrifice the front garden? Does it mean that I can maybe sacrifice a living room space downstairs? Versus maybe waiting a little bit longer to buy.
Yeah. When a lender's assessing a first-time buyer's application, will they also look at sort of history and what their expenditure's been and whether they've got any debts and things like that?
Yes. So if you look at credit history as an example, that will be evidence of your upkeep of historic payments. So for example, things like a credit card, a personal loan, car on finance, what we call committed expenditure, where you've got credit agreement with another lender.
So there's no harm in having that, but you need to be seen that you can manage it.
Exactly that. And that will give a lender an idea of how responsible you are at keeping up with your monthly payments, and then make an informed decision on what that means for a mortgage.
I read somewhere recently, and it was quite surprising, that the most first-time buyers are taking out a mortgage of 32 years now. That was a surprise.
Yeah. I think as of March 24, actually, this year, you're absolutely right in saying the average mortgage term for a first-time buyer is 32 years. Now, I don't know about you, Phil, but I don't know what I'm doing in 2 years, right? So 32 years to me is a really, really long time, and you might disagree. I'm not sure. And that's why it's so important that first-time buyers also take into consideration that it's not a commitment just for today. It's a very long-term commitment as of the future. So when you think about things like budgeting on a monthly basis, when you think about setting aside expenditures for what it will look like in your new property, it needs to be a well-rounded picture. And the good thing is a broker and a lender will sort of do some of that work for you.
Okay.
As opposed to kind of just getting your mortgage application over the line for today.
Yeah. The 32 years was a surprise to me, because I always thought it was like 25. But I guess that's eked out a bit longer as property prices have got higher, deposits have become harder to put together.
Yeah. And if you think about how much can change over 32 years in your own life and circumstances.
It's impossible to imagine.
Exactly. I mean, I like planning, but I definitely would like to plan for the next 32 years, right? So it really goes to show how important it is to get it right the first time round.
Can we talk a little bit about the different types of mortgage that are available specifically to first-time buyers?
Sure. I guess the first thing to understand is the type of mortgage and the product type are two different things. Again, this is something that I find myself explaining to first-time buyers quite quickly up front, because there's a lot of jargon in the mortgage world and everything sounds really similar, right? So the first thing is a mortgage type. So there's a couple of different types of mortgages that could be available to a first-time buyer. The first one, which is probably the most common, is what we call a repayment mortgage. A repayment mortgage does exactly what it says on the tin. You would be paying back the mortgage on a monthly basis, okay? Some of this payment will be towards the interest, so the interest rate that's agreed between you and the lender. And then the rest of it will be going towards the capital of the balance, which in theory means at the end of the mortgage term, 32, 35 or up to 40 years, you would end up paying the mortgage back in full if you keep up with your monthly mortgage payments.
Got it.
The other one that's probably not as common for first-time buyers is what we call interest only. I don't want to talk too much about it. However, the interest only element side of things is essentially a mortgage where you're not paying down any of the capital in that agreed term. You're only paying down the interest based on the interest rate that you've agreed with the lender, which means at the end of the term, you would still owe the full balance, and that's your responsibility to kind of pay it off in full at that point.
Do you say not that many first-time buyers take out interest only?
Correct.
Okay.
Not many first-time buyers would be eligible for an interest-only mortgage. That's why it's really important to seek the advice up front.
Okay.
Naturally, for a lender, interest-only mortgages, it's slightly higher risk. And so for a first-time buyer who doesn't have the history of keeping up with mortgage payments, might be looked at in a little bit more detail. So it's important to seek the advice.
Okay. Moving on. What are the other types of mortgages?
So you've got mortgage products, right? Which is always an exciting topic for me anyway. And I don't think first-time buyers would agree, but it's really important to understand that there are different types of products that you can essentially layer on your mortgage, okay? The fixed rate is probably the most common one for a first-time buyer. And my view is, I think the reason is because fixed rate gives you stability. When you are purchasing a home for the first time, it's important to be able to get that foundation level of stability upfront to help you plan for the future and kind of get used to things in the house, right? You've got tons of outgoings that you never had before. So a fixed rate, you and the lender will agree on an interest rate, which will then determine a fixed payment on a monthly basis for a period of time. So you might ask, how long is that period of time? And that will depend on the lender and the products that they've got available at the time.
Yeah.
Some examples though, and you might hear quite common, is a 2-year fixed rate, 5-year fixed rate, 3-year fixed rate. Some lenders even go all the way up to a 10-year fixed rate, depending on what's on sale at that time. What's also just as important to bear in mind for a first-time buyer is at the end of that period, what happens? You should definitely seek to speak to your lender before that deal is up for renewal. Like you would, for example, I always say, like with your phone contract, before your deal's coming to an end, you have a look at your options, see what's available, what the cost is, same concept. Speak to them beforehand, understand what other products are on sale, and then renegotiate a new deal. And then on the flip side to that, you've got what we call, another example, is a base rate tracker. This interest rate tracks the Bank of England base rate directly. It is a variable product, so it's quite the opposite of a fixed rate. It means that your payments could fluctuate on a monthly basis. If the Bank of England base rate did move, then your product and interest rate would move up or down in line with that. That's probably not one that first-time buyers kind of gear towards initially anyway when you're first taking out a mortgage, just because the level of instability on a monthly basis can cause other stresses in finances.
And what about first-time buyers who are looking for a bit of extra support, a bit of extra assistance to help them get onto the ladder? Can we just chat a bit about some of the schemes that are out there?
Yeah. I love this question, Phil, and my initial response is a lifetime ISA. It's an absolute no-brainer. For those people who aren't familiar with a lifetime ISA, you need to be aged 18 to 40. It is a government-backed scheme that basically helps you save up for your home. It gives you some discipline, really, in order to kind of tuck that money away on a monthly basis or yearly basis. But what you can do is save up to £4,000 per year tax-free. In a lifetime ISA. And then you'll get some government contribution, which is up to 25%, and that works out to be up to £1,000 per year. So it's a no-brainer.
Got it.
Right? I think it's a fantastic scheme for first-time buyers to save up for a deposit for their first home.
It's been really popular, really widely taken out.
For the right reasons. It's an absolute no-brainer. And it's a shame because I think not many first-time buyers know about it. And if they do know about it, and I'm not sure that people understand the concept that sits behind it. But actually, when you think about the concept of a lifetime ISA, how that fits into buying your first home and how a mortgage works, I think people will quickly realise that they both go hand in hand. And it's a great initiative that's backed by the government, so why wouldn't you?
As you said, it's a great discipline.
Absolutely.
Helps you save. It's tax efficient anyway.
Yeah.
And what about shared ownership? And there's also the joint borrower sole proprietor schemes on there.
Great, absolutely. Shared ownership is another one that's quite popular if your circumstances fit around that. Absolutely. Joint borrower, sole proprietor, a bit of a mouthful sometimes, isn't it? So a lot of lenders have actually renamed that to what we call income booster. Nice and easy, flows off the tongue, but it also does exactly what it says on the tin. It's one of my favourites, actually. Income booster. You can have up to 3 applicants on your mortgage in order to boost your income, and that in turn increases how much you can afford.
So it's your property, it's your mortgage, your property, but you've got other people to support you in your application.
Absolutely.
Did I get that right?
Absolutely. So your joint borrowers, there could be up to 4 of you on a mortgage. So you're borrowing together, but the sole proprietor means actually you're the only person. So one person owns that property. And the sole idea behind Income Booster is in order to increase your borrowing capacity and get you into your first home quicker with the help of even family or friends.
Because the lender will look at their income in order to assess the application.
Exactly.
But of course you need to be 100% confident that whatever you borrow, that you can support that debt.
For sure. So you are solely responsible. However, what you will have is the idea of being able to unlock a higher budget quicker with the support of people around you.
And could you share any kind of practical advice for people managing their mortgage payments and just being really diligent about it?
Definitely. Plan in advance. Okay, have a real think about what the reality will be in this new home. We talked a little bit about today on how a lot of first-time buyers focus on kind of getting into the home, and this question directly relates on what happens after that. So yes, you've got a mortgage payment to keep up with, but actually you've got costs associated with running a home now as well. Typical first-time buyers who have, for example, been in renting or living with parents, talking about running a home and then being in a property where you've got things like council tax, gas, electric, water to really budget towards can change things, right? So one is to get your head around that planning piece. Two is do your research. So what's the council tax banding in this new property? What's the reality of what that monthly outgoing will look like? Have a look at some comparisons for things like your home insurance, your life insurance, which now is going to start kind of creeping on top of the list, right? If you're taking out a mortgage, these things are really important to take into consideration. But outside of that, I mean, I think a really good practical kind of piece of advice from me would be, if you know that you've got prime months in the year, and we all have that, I have that, a car insurance is up for renewal, service is due, MOT is due, tax is due, it all comes around like within a short space of time. If you know that's happening, have a contingency so that you're comfortable to keep up with your monthly mortgage payments as well as everyday life in the new property.
Plan. Very good advice. And I always think it's that first year, the first year of home ownership, where there's quite a lot of shocks because you've got to furnish it and your council tax and your TV license, as you say. Once you're up and running, it settles down a bit. But the first year, you've really got to be on top of your game, haven't you? Just to finish off with, any sort of more wider practical tips for first-time buyers when they're going through all of this? Yeah,
speak to an expert. Absolutely. You don't know what you don't know when you're going through something for the first time in your life. That's with anything. And if you seek to speak to the right person, they can guide you, right? If you might not be ready to get a mortgage or buy a home today, a broker or a professional expert will be able to guide you on planning ahead. So if you're not ready today, when can you be ready and what do you need to do to be ready? And the good thing is the industry experts, so for example, a mortgage broker, they have the experience and the qualifications that you wouldn't have. Right.
There's lots of help out there, but equally there's a lot of jargon to understand, and you want to be really clear about what you're getting into.
Yeah, absolutely. The other good thing is on that jargon, I think a lot of lenders are recognising that these days, right? And they're doing a lot of different things to try and break down some of that jargon for first-time buyers, to try and help them understand the process. I think that signposting and clear expectations, that's fantastic to set expectations. Outside of that, you've also got other toolkits, so things like affordability calculators, which most lenders have on their websites. You would have access to that, kind of give you some baseline understanding of what you might be able to borrow, and a step-by-step process on what to expect throughout.
Umera, great advice, really important advice as well, so thank you so much.
Thanks, Phil.
Thanks for joining us on this episode of Move IQ's First Home Focus podcast. We hope you found our tips and advice helpful. And remember, home ownership may be closer than you think, and we are here to support you every step of the way. So please don't forget to subscribe, rate and review our podcast so you never miss an episode. Until next time.